Look at this $100 bill. It looks solid, right? But what if I told you it's actually melting every single second you hold it? In the next 10 minutes, I'll show you why your savings are under attack and why the world's smartest investors are fleeing to gold. First, we must talk about the invisible thief. You might know it as inflation. It's the reason why a loaf of bread costs way more today than it did for your parents. To understand why this happens, we need to look at M2. Think of M2 as the total bucket of all the cash and bank deposits in the economy. When the government prints more money increasing, the M2 supply there is more water in the bucket, which makes every single drop less valuable. Right now, the U.S. national debt is over $34 trillion. That is a number so big, it's hard to imagine. It's a debt that can likely never be paid back in full. When a country owes this much, they often use fiat currency. Fiat is a Latin word meaning by decree. It means the money has value only because the government says so. But history shows a dark pattern. The average lifespan of a fiat currency is only about 27 years. Eventually, they all lose their value and vanish. Gold is different. It cannot be printed. It cannot be decreed into existence. It must be pulled from the earth with sweat and massive effort. This is why we call gold a hard asset. It has scarcity. There is a limited amount of it on Earth, which protects it from the invisible thief. Central banks know this. Recently, they've been buying gold at the fastest rate in decades. They are trading their paper for truth. In the next chapter, I'll show you exactly why the price of gold is screaming toward new highs right now. So, why gold? Why not silver, iron, or even diamonds? To understand this, we have to look at the periodic table. Most elements have a problem. Iron rusts, copper turns green, some are gas, and others are radioactive. Gold is the Goldilocks element. It is chemically inert. This is a fancy way of saying it doesn't react with anything. It doesn't rust, rot, or burn. It is forever. But being pretty isn't enough. Gold has survived because of the Lindy effect. Let me explain what that is. The Lindy effect says, the longer something has survived, the longer it's likely to last. Gold has been money for 5,000 years. In contrast, most paper currencies, what we call fiat, usually fail within a few decades. Gold is the ultimate survivor. Another key reason is counterparty risk. This is the risk that the person or bank you are dealing with might fail. When you own gold, you don't need a bank or a government to keep their promises. It has value all by itself. No strings attached. Think of it as a battery of human labor. It takes massive energy to find and mine it, and that energy is stored in the metal. Finally, it is divisible and portable. You can melt it, split it, and take it anywhere in the world. It's the universal language of value. Now that you know why it has value, let's look at why its price is hitting record highs right now. The reasons might shock you. We are witnessing something historic. Gold isn't just rising, it's breaking away from every old rule in the textbook. But why now? The first reason is a massive shift by central banks. They are dumping US dollars and buying gold at record speeds. This is called de-dollarization. De-dollarization. It's when countries decide to stop relying on the US dollar for trade and savings to protect themselves from US political influence. Next, look at the debt spiral. The US government is spending far more than it earns. This creates a massive fiscal deficit. A fiscal deficit is simply when your outgo is bigger than your income. To cover this, they print more money, which makes your savings worth less. Then there's the fear of a hard landing. This is the worry that the economy will crash suddenly because of high interest rates. Investors are watching real interest rates. This is the interest rate you get from the bank minus the rate of inflation. If inflation is 5% but your bank pays only 4%, your real interest rate is minus 1%. You are losing money by keeping it in the bank. That's when gold shines. Geopolitics is the final spark. Conflicts around the globe are making paper assets feel risky. Gold is the ultimate safe haven. Finally, look at the supply. Gold mines are struggling to find new deposits. We are reaching peak gold where production can't keep up with demand. More buyers, more debt, and less gold. It's the perfect storm. In the next chapter, I'll show you how to use this storm to protect your family's wealth. But be careful, not all gold is equal. I'm going to reveal the traps most investors fall into. Stick with me. Imagine a massive storm hitting your house. You don't buy insurance while the roof is flying off. You buy it when the sun is shining. Gold. Is that insurance? In investing, we call this asset allocation. It's just a fancy way of saying, don't put all your eggs in one basket. To build a strong shield, we need to understand the correlation coefficient. This measures how two different assets move together. Think of it as a mirror score. A score of +1 means they move exactly the same. But gold often has a negative correlation with stocks. This means when the stock market catches a cold and crashes, gold usually stays healthy or even gains value. It balances your pain. Look at history. During the 2008 financial crisis, the S&P 500 dropped nearly 37%. But gold, it finished the year up about 5%. This is the power of purchasing power. While the dollar buys less bread every year, an ounce of gold buys roughly the same amount of stuff it did 100 years ago. So, how much should you own? Most pros suggest a 5% to 10% allocation. This is enough to protect you without slowing down your growth. But remember, gold has an opportunity cost. Since it doesn't pay dividends or interest, you lose the hidden profit you'd get from stocks. This is why we remain objective. Gold isn't a get-rich-quick scheme. It is a wealth preservation tool. It keeps you in the game. By holding a little gold, you sleep better at night. You aren't gambling on the future. You are prepared for any version of it. Now you have the strategy. But how do you actually buy it? Physical bars or digital assets? Let's break down the best ways to buy in Chapter 5. Now, the big question. How do you actually get started? There are 3 main ways to own gold, and each has a different flavor. First is physical bullion. This means real gold bars or coins you can hold in your hand. Bullion just refers to high-purity gold used for investment. It offers the best security because there is no third party involved. But you have to worry about storage and insurance. It's your own private vault. Second is a gold ETF. ETF stands for Exchange Traded Fund. Think of it as a digital certificate that represents real gold sitting in a vault. It's as easy to buy as a stock. You get the price movement of gold without having to hide it under your bed. High liquidity, zero storage stress. Third is gold mining stocks. These are companies that dig the gold out of the ground. These provide leverage. Leverage is like a magnifying glass. If the price of gold goes up 10%, a mining stock might jump 30%. But be careful! It works the same way on the way down. To recap the strategy, physical gold is your wealth insurance. ETFs are your trading tools, and gold miners. They are your profit accelerators. Match the asset to your objective. But here is my final warning. Beware of paper gold traps. Some platforms sell you gold they don't actually have. Always check the fine print. Gold is not about getting rich overnight. It's about ensuring you never go broke. It is the ultimate freedom from a broken financial system. History is a cycle of paper falling and gold rising. Don't wait for the crash to take action. Build your shield today.